On November 18th, 2021, a new kind of fast food giant was born. Sweetgreen was the perfect company for the modern world. Healthy, tech-savvy, and impossibly cool. It was the Starbucks of salad, and with a valuation that rocketed past $5 billion on its first day of trading, it seemed unstoppable. Investors were ecstatic. The future of food was here. Fast forward to today, and that $5 billion dream has turned into a nightmare. The company is in a freefall, fighting for its very survival. But this spectacular collapse wasn't caused by a single scandal or a bad economy. It was caused by a fatal flaw that was hiding in plain sight inside every single $16 salad they sold. The company was founded in 2007 by three recent Georgetown University graduates called Jonathan Neiman, Nicholas Jammet, and Nathaniel Rue. Tired of the unhealthy, boring food options available near them in Washington, D.C., they came up with a simple idea. What if you could get a healthy, delicious meal, but as fast as a burger? From their college dorm room, they planned a business that would sell hot and cold salads, with fresh ingredients bought from local farmers. After raising $300,000 from 50 investors, they owned their first location in August 2007. It was tiny, just a 560 square foot spot in Washington, D.C., near their university campus. For years after that, Sweetgreen grew steadily, building a reputation for good food, great ingredients, and a cool minimalist aesthetic. What made the business work is that they weren't just selling salads, they were selling a lifestyle. They were as much a cultural phenomenon as a restaurant, even launching the Sweet Life Music Festival, blending food, music, and community into a powerful brand experience. Then the venture capital money started pouring in. In 2013, Revolution Growth, the fund led by AOL co-founder Stephen M. Case, made a significant $22 million investment. By 2018, a massive $200 million funding round, led by Fidelity, valued the company at over $1 billion, which officially made it a unicorn. Sweetgreen had invested heavily in its digital platform, pioneering mobile ordering and delivery long before many of its competitors. This wasn't just a salad chain anymore. This was a tech company that sold food. By 2020, over half of its revenue was coming through its own app, and by the following year, Sweetgreen was running over 140 locations. The three founders decided it was time to go public. The initial public offering allocations were announced on November 18th, 2021, and was a massive success. The stock, initially priced at $28, opened at $52 and closed the day at $49.50. Their mission was perfect for the time. In a world increasingly focused on health, wellness, and sustainability, Sweetgreen was in the right place at the right time. It was a tech-forward, ESG-friendly company with a loyal customer base and huge room for growth. It was going to conquer the world, one harvest bowl at a time. The mainstream breakthrough seemed inevitable. Except it wasn't. The first big sign of trouble appeared in August 2022. Sweetgreen announced it was laying off 5% of its corporate workforce and downsizing its headquarters. At the same time, it slashed its financial forecast for the year, citing a slower return to the office than expected after the COVID lockdowns. The stock plunged. The core problem, one that has plagued Sweetgreen ever since, was that its value perception had slipped. With bowls often costing $15 to $20, Sweetgreen had become a luxury for many. The company's growth was built on well-paid, white-collar workers in major cities. But when the pandemic shifted work patterns and inflation began to bite, that strategy began to unravel. Fewer people were visiting their stores, especially in its urban core, as people began working from home more often, and those that did come into the office who did sought cheaper lunch options. Sweetgreen, still as focused on cutting-edge tech as good food, tried to innovate its way out of the problem with an ambitious automation investment. In August 2021, just before its IPO, Sweetgreen bought Spice, a Boston-based startup founded by MIT graduates that had developed a robotic kitchen. The idea was to create infinite kitchens, automated restaurants that could make salads faster and better than human workers, dramatically cutting labor costs. The first infinite kitchen opened in Naperville, Illinois, in May 2023. But instead of being faster and cheaper, their robot revolution was slow and expensive. In the end, even that was a side dish to their main course of problems. Because while the company was pinning its hopes on the future, its present-day business was struggling. One problem was that it found itself in legal trouble. In April 2023, Chipotle sued Sweetgreen, alleging that its new Chipotle Chicken Burrito Bowl infringed on Chipotle's trademark. The lawsuit was quickly settled, and Sweetgreen renamed the item as the Chicken plus Chipotle Pepper Bowl. But it was an embarrassing misstep, and it looked like the company was losing its focus. Throughout 2024 and 2025, the bad news kept coming. The company consistently posted huge losses, quarter after quarter. An ongoing issue was that despite the sales beats that were mixed throughout their history, Sweetgreen had never once been profitable. Before long, even their fairly consistent top-line revenue growth began to disappear. On May 9, 2025, the company reported its first decline in comparable store revenue when compared to the previous year's sales. Since its IPO, a 3.1% increase compared to the previous year's 5% increase. But it was still an increase, and across the business, revenues had gone from just under $158 million the year before to just over $166 million. Even so, it must have been seen as a warning because that same day, Sweetgreen cut its financial guidance. The guidance that's meant to help them make informed financial decisions for the second time in less than a year. That was seen by outsiders as a clear sign of weakness. The company was getting tossed around from all sides. Customers began complaining about smaller portion sizes and poor quality, damaging its reputation. In August, the company's stock plunged over 27% in a single day, following its disappointing second quarter results. They also announced another round of layoffs, cutting 10% of its restaurant support center staff. In response to the crisis, Sweetgreen began foraging the ingredients for a recovery. They shifted towards cost-cutting, menu simplification, and asset monetization. To win back customers, it announced larger portions and added cheaper items. In early November, the company posted a wider-than-expected loss of 27 cents per share. The company blamed a challenging consumer environment, but the market was unforgiving. Just days after, Wall Street completely lost faith. Investment banks like Goldman Sachs, William Blair, and TD Cowen all downgraded the stock, citing concerns about slowing growth and a turnaround timeline that remained unclear. The stock, which had debuted at $52, was trading in the single digits. Then, the robot revolution ended, when the Spice Robotics business evolved into a sale rather than a long-term owned asset. Sweetgreen gained $100 million in cash, along with $86.4 million in stock from the purchaser, the restaurant super app company Wonder. It was a clear admission that the plan to fully automate its kitchens was not the quick fix they had hoped for. Following the Spice sale, Sweetgreen announced a tighter outlook, slowing its new store openings to a rate of 15 to 20% by 2026. Some analysts even guessed that the company's plan could include adding French fries or soft-serve ice cream, a dramatic departure from its health-focused roots. So what went wrong? The biggest problem is that the price problem was never solved. Sweetgreen's entire brand was built on premium ingredients, which came with a premium price tag that alienated mainstream consumers when the post-pandemic economy began to bite. They had to find a way to become a tasty option for the customers and the market again during a cost of living crisis. But they couldn't, because there was no way to scale up fast enough to bring prices down because prices were too high to attract the scale of investment and footfall they needed. But that wasn't the only issue. The company was also caught between being a tech company and a restaurant company. Its heavy investment in technology was supposed to be an advantage, but it distracted from the basics of running a restaurant. And the market simply wasn't as big as their investors had hoped. The demand for $16 salads, it turned out, wasn't infinite. Sweetgreen's loyal, urban, well-paid customer base was real, but it was a niche. To justify its multi-billion-dollar valuation, it needed to break into the mainstream, and it couldn't. The company is still expanding into new markets, like Michigan, but its overall growth has slowed significantly. As of the most recent updates on the uploading of this video, the company is undergoing a painful pivot from a fast-growing star to a lean operator, trying desperately to prove it has a sustainable business model. Their story is a cautionary tale about hype, the challenge of growing a premium brand, and the difference between a good idea and a viable business. The concept of healthy, convenient food is a good one, but none of that matters if only a few people can afford it. Could Sweetgreen turn it around? It's possible, if the company can successfully broaden its appeal, improve efficiency without sacrificing quality, and convince customers it offers real value. It might find a path back to growth. But that's a lot of ifs, and time is running out. Thanks for watching my video to the end. If you want deeper dives into stories like these and be first in line to know about distressed debt, leveraged finance, and bankruptcies even before they're known to the public, you need to sign up to my credit newsletter. Use the link below to see what's really happening as it's happening. And click the video above to find out how Carvana learned the hard way that forgetting who you are can lead to disaster.